Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to the Colliers Talks podcast, and we're having our first ever return guest, Claire Fan of RBC Economics. I'm Adam Jacobs. I'm the National Head of Research at Colliers Canada, and I'm very happy to be joined by Claire. Claire's an economist, as I said, at RBC. She joined in 2019, focuses on the macro outlook for Canada and the U.S., and responsible for the forecasting side and in terms of GDP, employment, and inflation. Her publications include the Inflation Watch series, very popular topic these last couple years, I'm sure, and analysis of labor market trends, recession probabilities, and inequalities. So the topic of this episode, the state of Canada's economy, the implications of various events and challenges our country is currently facing since we last talked, elections, so many global affairs issues, let's say politely, that we need to contend with. So we're going to be discussing that today, and I hope you enjoy it. Okay, Claire, we had you on last year, and it was it was a simpler, more innocent time. I think we thought it felt very chaotic at the time, but now the chaos has been ratcheted up a level. We've had a trade war with the United States that I think nobody saw coming. Certainly I didn't. And we had a federal election in Canada, a change of leadership. There's so much going on. So we want to dig into the economic implications of all of this. Let me start with one that maybe we don't talk about quite as frequently, which is the Canadian dollar. This has huge implications in our real estate world and in the economy generally and for inflation. But I think the fear was with the U.S. economy on the upswing that generally the way this goes is the U.S. dollar benefits and we perhaps suffer and our currency gets weaker. That seemed to be happening maybe initially at the beginning of the year, but now that seems to have flipped around the other way. So can you elaborate? It seems like the usual rules and cause and effect aren't quite working as they normally are here.
Yeah, for sure. So I think that was one of the things that was kind of surprising coming out of the trade war was kind of like you mentioned, the sort of the financial market reaction almost later on to the tariff, specifically to reciprocal tariffs that were announced in early April. So normal times, we think about the US dollar and US Treasury. You know, these things are what we call safe haven assets. And, the US dollar is sort of the most concentrated reserve currency as well. And those two kind of goes hand in hand. There's more demand for US Treasury, which usually prop up the value of US dollar. And then during downtimes were historical, at the onset of, let's say, the global financial crisis, what we would see typically is global investors would fly to safety is what we would call them. And then the value of both U.S. Treasury as well as the U.S. dollar would go up. But that's not what we saw in April. Very interestingly, the value kind of both. So we saw long U.S. bond yields increasing quite a bit during the week after reciprocal tariffs or Liberation Day. And then the U.S. dollar on a broad trade weighted basis is still down over 5% from January. So it's very interesting. And part of that is really mechanical. And our fixed income strategists have talked about this, which is there's been a little bit of unwinding of specific swap trades that were happening earlier in the year that drove sort of the bond yields higher. But the other part of that, which I find is kind of the more important question as to whether this is just something that we're going to see for now or whether this is going to be a trend that's going to persist in the future, is this broad idea of investors losing confidence in the U.S. economy and, what it stands for global economic stability and broadly in U.S. government asset, as well as sort of elevated level of U.S. government debt as well. So all these things kind of, morph together maybe have driven some of the increase in bond yields as well. And the Bank of Canada in their financial stability report a couple weeks ago actually talked about this. They didn't really say or speculate whether this is going to be something that's going to persist in the future. But if it does, which is, if global investors are starting to ask for a higher premium for U.S. assets, then that's going to have a pretty big impact. I mean, starting from, if you think about US debt, which is already pretty elevated, and how much the government is paying on interest payment, they're paying more interest payment in 2024 fiscal year than they paid on defense spending. So that's a lot of spending on interest. So higher bond yields is only going to make that worse. And US dollar obviously is just going to exacerbate the inflation shock, which is already expected to be large this year due to the tariffs.
Yeah, and it's confusing to me because on the one hand, we've talked about this for years. There's going to be a move away from the U.S. dollar. The BRICS are going to have their own separate thing. We're going to transact oil in a separate currency, but it never seems to quite arrive. Like we've been talking about this for 5, 10, 15 years. Just if you can opine a little bit, this is a good thing for Canada in the sense that our currency is valuable, it keeps inflation at bay, or this is a bad thing just in the sense of the instability, things are falling apart.
I mean, to the extent that, it's economic weakness that's driving what we're seeing behind the dollar movement, it's really not so much a good thing because, Canadian companies and businesses, we still do export disproportionately to the US. So a lot of what we produce and what we kind of count in GDP, domestic production, is tied to how much the US is demanding, not only from us, but very globally as well. So all else equal, if tariffs are going to drive a much softer and weaker US economy this year, that's not a good outlook for Canada.
Fair enough. Speaking of the outlook for Canada, let's turn to a big topic again. And the real estate side is always tied very much to the job market, certainly office real estate, but just the consumer spending, everything else, the housing market. So we went through this COVID yo-yo with the job market. Inflation's at all-time highs, then inflation's at all-time lows. Maybe 3 years ago, we remember those stories. There's 1 million vacant jobs in Canada. We can't hire anyone. And now we've sort of settled back to a normal-ish level. When we look at this, we're at the same level of unemployment we were 7 or 8 years ago. But I guess the trade war has really upended this. I guess for a while I thought, okay, it's just kind of leveling out. We're at a normal level. But what is the outlook for the labor market? Like, this can't be a good thing overall, but are we worried about inflation unemployment is going to double, to go up a ton, or have we already sort of reached a peak?
Yeah, that's a good question. I think it's one of the key questions actually the Bank of Canada will be watching out for. We're thinking about in terms of their interest rate decisions moving forward. Well, you kind of talk about a really sort of long horizon over the past decade. So I'll shorten that up a little bit and talk more specifically about last year. Last year, towards the end of 2024, was when we were kind of getting close to, or actually, we saw a couple rate cuts, right, already from the Bank of Canada. And that's because, like you said, inflation dropped by quite a lot in Canada. And what we saw was also this broad recovery in the Canadian economy as well as the labor market, partially as a result of the rate cuts that we've seen that boosted, borrowing. Um, Sort of demand, essentially businesses finding and households finding it easier, cheaper to borrow money again. So it's easier for them to spend. So just easing monetary policy and how that stimulates the economy, right? So we did see some of that, and we saw the unemployment rate started to drop. And so that was the backdrop ahead of tariffs, ahead of the trade war, was a labor market that was broadly in recovery mode. And of course, a lot of that went away since January. And I would say a lot of sort of the initial earlier on impact, because to be fair, from January to March, we didn't exactly see huge tariffs, more so just rumbling, just anxiety and, businesses hearing about these potential tariffs that are incoming. So it's not so much the tariffs themselves that were driving job losses, it's a sentiment hit. Right. So businesses were in the position where it's a lot of instability. They don't know where to look or what to expect, essentially. So in that kind of a position, which is still kind of the backdrop a little bit today, but arguably it's gotten a bit better, it's very hard for businesses to make any sort of decisions. And hiring is obviously one of the most important decisions that a business can make. So we did see job openings started to drop pretty substantially since January. And that was upon this recovery since the latter half of 2024. And then afterwards, we got the jobs market report for April. I would say April was the first month that we saw some pretty substantial impact, actually. You do see the unemployment rate rising by 2/10 from 6.7 to 6.9. And in parts of Ontario where manufacturing is really, really important, is a lot higher. So there were clear signs that tariffs were hitting Canadian jobs market. And then in terms of forward looking, so now we're kind of already seeing tangible impact from tariffs on the labor market. That's the big question, right? As to, is this going to be something that's potentially more limited? We're only going to see it in a handful of sectors, which we are already. For example, manufacturing that lost over 30,000 jobs in April. Or is this going to turn into something that's much bigger, right? Are some of the other sectors also going to see job losses just because of secondary impact from tariffs, reduced domestic demand, and a broader, just weaker economic backdrop? So I think that's the key question, but we're not there yet. I think so far what we're seeing is pretty limited still in terms of the scope of the tariff impact on labor markets.
Yeah, and I want to drill in a little more because this is something. The more we look at it, the more it's like the impact of tariffs is quite uneven. There may be a report that says, okay, overall 1% GDP hit or 1% unemployment hit, but it's very uneven in terms of geography or what industry you're in. So this is quite apocalyptic, maybe for agriculture, resources, automotive, metals, some of these industries. Maybe other industries, consulting, legal, insurance. These are not export industries. They're not import industries. It's sort of you operate with local employees in the local market. So is it just going to be across the board? You mentioned there's knock-on effects, or can we say maybe some areas are a bit insulated if we're talking about job market, job losses, where obviously tariffs are not a good thing, but are there some areas where it's just not going to be a major factor?
Yeah, I think, well, like you said, sort of the broader domestic services sector, when you think about restaurants and, potentially some other services as well, financial services. Actually, finance and insurance was one sector that saw pretty solid job gains since January, partially just due to sort of the volatility that we're seeing in financial market activities. But yeah, there are definitely sectors that are more insulated than, if you think about manufacturing. And regionally, that also has implication as well. So in Ontario, for example, the unemployment rate rose to the highest it's been in a couple of years, versus in some of the other provinces, it's largely flat. So we're not seeing nearly as much of an impact.
Yes, it's interesting. I'm going to the prairies next week, and when you slice through the data, there isn't as much of an effect maybe in Winnipeg or Saskatoon as there is in southwestern Ontario or some other areas. Anyway, it wouldn't be a Colliers Talks podcast if I didn't ask you about it's year 6 and we're still discussing return to office. So we have been talking about the labor market and return to office for some time, and there seems to be a strange sort of kind of negative connection in terms of a very strong labor market seemed to actually slow return to office. The employees had the upper hand, they had some leverage, and that was partly expressed in rising wages and low unemployment, but partly in the negotiation about hybrid work and return to office. So does a weaker labor market actually, what does that mean for return to office? Are we going to see employers pushing on that more, or is return to office just not even like in the top 20 things we're considering because of all these other problems in the world? Do you have, this is a little outside the normal economic discussion, but I just wonder what you see there.
Yeah, no, that's an interesting point. I don't think I've ever thought about it like that. That sort of power dynamics between employer and employees. And yeah, it may very well, kind of give employers a bit more leverage to kind of call their workers back to the office. But I would say from sort of a broader economics, backstop, um, in terms of just how many workers and how much employment growth, obviously our outlook is that we're still going to see the unemployment rate rise a little bit more. It's at 6.9. We think is going to increase to around 7.1%. Obviously, that's a very sort of arbitrary point estimate, but the idea is it's going to soften a bit more. But then that kind of goes back to my earlier point, which is if you do see just moderate softening, further softening, kind of what we're expecting right now in specific sectors, then maybe it's not going to be so incredibly damaging to the whole sort of office occupancy levels that we're seeing right now. And especially given what we just talked about, the jobs that usually do go into office are also the jobs that don't tend to be impacted by tariffs. But if this were to turn into something much bigger of a downturn, if we're looking at near 8%, obviously that's just not friendly to anything, to the labor demand, to the workers involved, and not to return to office either.
Certainly not. Okay, let's turn to politics, non-U.S. politics. How about Canadian politics? We just had one of the more surprising elections, I think. Huge turnaround. The Liberals are still in charge, and we're seeing, I would say, a mandate for let's get the big projects off the sidelines. Let's do some really visionary stuff. We have to build pipelines, break down trade barriers, whatever. So there's going to be a lot of new spending. Where are we going to see that? Is it about subsidizing the impacted industries? We've seen that in Ontario. Okay, we're going to subsidize the auto industry. Or is there going, where are we going to see the impact of that spending in terms of like geographically or what industries?
Yeah, so before I get into that, I think a helpful sort of background is the fact that Canada, relatively, where the Canadian federal government is in a better spot when it comes to debt to GDP comparing to other G7 countries. So there is more room in terms of fiscal spending for it to increase. So what's been announced so far are kind of the areas that you would kind of normally expect. So in education and workforce development, there's the Upskill Canada, which is just aiming to help workers kind of get used to this, sort of new technology with AI and everything, making sure that they can keep up with changes in the workforce and remain employed. And there are other spending on healthcare, which are direct spending, obviously, to healthcare infrastructure, but also to address labor shortage. And that's one of the things we've been pointing to, which is that, the Canadian population is going to continue to age. And with immigration slowing so much, labor shortage may be back sooner than employers are expecting. So, especially in the couple of sectors, if you think about healthcare, if you think about construction, so these are the sectors that could really see a larger impacts moving forward as well. So there's some amount of spending to address that as well through international programs. And like you said, there are obviously major infrastructure projects on different areas. I talked about healthcare, and there's also on public transport and some other areas as well. But those might be on the sidelines for a bit. And then other areas that, it's just housing, climate, and defense. There's some of the common areas that they've been sort of pointing to.
Yeah, and I think in a way it's good news for us. I mean, real estate is quite tied to infrastructure and an improvement in rail, ports, airports, transportation, pipelines, all of this. It would be helpful. The fear, I think, is how long those infrastructure projects tend to take. Like, it's great that we're getting off the sidelines and doing those, but perhaps the impact of that is really 5 to 10 years down the road, realistically, for some of these projects. But I think in a way there's a sense of urgency that maybe wasn't there a year ago, and that isn't a bad thing. So, okay, let's talk about, I'm sure you've spent literally years of your life on this, but interest rates. Yeah, we are perhaps the most interest rate sensitive industry. We live and breathe Bank of Canada rate cuts and what's happening in the debt market. But where is this going? Because we tend to look at all the forecasts of RBC and the other economists, lenders. I think even maybe 3-4 months ago, everyone agreed we had several rate cuts in 2024. There's obviously going to be more rate cuts. We're not yet at the neutral rate, whatever that is. But maybe that was the old paradigm, and now we can't think that way anymore. You even see some argument that perhaps rates need to go up because inflation could return in some ways. So where do you see it? What's the forecast now? Is it just we're holding for the rest of the year and we can't make a decision either way, or is there more easing needed?
Yeah, so I think the broader interest rate outlook is very contingent on the economic outlook, and I can't talk about one without talking about the other. So what we're expecting for the Bank of Canada is essentially, that they are near or maybe they're at terminal. So we're expecting moderate cuts, 1 to 2 more potentially, but that kind of an outlook is also very contingent on, what we're expecting out of the economy. So I mentioned before that I expect we're RBC economics, we're kind of looking for the unemployment rate to continue to increase a little bit, further deterioration in labor market as well as smaller GDP growth, just an overall pretty soft outlook for the Canadian economy this year. And then that goes hand in hand with obviously that there will be enough evidence that the Bank of Canada will look at and see, we're seeing job losses and we're seeing broader just domestic demand not holding up as well as we'd like to, even though rates are this low. So we're going to keep cutting to boost the economy. So that's kind of the outlook that we're expecting. But obviously, inflation plays a really, really big part. And I know we're getting into that topic later. But, the broader dilemma, right? I think we've all heard about it at this point, which is the bank has, well, in the US, they have like very clear dual mandate. In Canada, is very focused on the inflation side of things. They want to keep inflation contained and stable. This morning, actually, the day that we're recording, we saw sort of the CPI print for April that was quite a bit stronger than we were expecting. And it's also stronger in some of the categories that you wouldn't expect. So it's not really, auto prices did rise a bit faster because consumers arguably probably were trying to front run tariffs or price increases. So demand rose and we saw, higher auto sales kind of all coinciding with that side of things. But concerningly, we also saw more pressures were building in some of the domestic services areas that are, probably has nothing to do with the tariffs so far. So that's going to be a very concerning backdrop heading into the trade war for the Bank of Canada, which is if you have pressures already brewing at the background, then tariffs arguably is going to make everything worse, exacerbate sort of the inflation trends. So they're going to be very mindful for that. And then, also contingent on future labor market report. If they're more softening in job losses coming through, there's a need essentially for the Bank of Canada to support the economy. And this is true both on sort of the monetary side as well as the fiscal side. The last part we talked about how the federal government in the near term might be constrained by, just more spending or stimulus essentially directly or indirectly to the sectors and businesses involved or impacted by tariffs. That's always also going to be growing in proportion to further trade escalation. So that's something that we're expecting as well.
Inflation, everyone's favorite topic. We talked about this for years, and then at the beginning of the year, it felt like, okay, this is kind of done as a story. We're just sort of back to normal levels. But clearly, inflation sort of is a concern now. With the trade war as the double whammy of it could hurt growth and cause inflation. But when you and I spoke about this earlier, you said there's a lot of confounding factors, maybe more than ever. It's very hard to isolate what's actually happening because we had an HST holiday and then we removed it and then we changed the carbon tax and then tariffs and then how do we, can you talk a little bit about the confounding factors and just, do you feel inflation is at a normal level or it's rising or how can we even study that right now?
Yeah, like you said, there are a lot of one-time factors that have changed or influenced the headline CPI print. So what we tended to do as economists are basically we will look at some of the measures that exclude indirect taxes for a true gauge. But then, even those measures, so-called core inflation measures, and maybe I'm getting a bit too technical here, are still kind of broadly a bit concerning. As I talked about earlier today, we saw sort of the April CPI print and some pretty strong sort of pressures building in some of the domestic services categories. And, maybe that's also partially as expected because throughout sort of last year, November to earlier February this year, we saw the federal sort of tax holiday. And alongside that was a pretty strong increase in domestic demand. And personally, I definitely, went out to eat at restaurants more than I normally would just because, the taxes were gone during that period. So we did see a bit of that, right? The tax cuts boosting demand as it was intended to. And then earlier this year, even in today's print, there were also concerning signs. So again, the broad pressure going into the trade war is a bit worrying, I would say. So that's the first bottom line, essentially. And then the second sort of component of it going forward is obviously we did see the um, consumer carbon surcharges drop on April 1st for many provinces, and that pushed energy inflation quite a bit lower in April, and we saw the print already. And then, offsetting that over the course of next year is tariff impact. So what we were anticipating before was that each of those factors would add and or subtract about 0.5%, 0.6, 0.7 percentage point of impact to sort of the headline inflation index. But then the timing is tricky, right? Because obviously the dropping of consumer carbon pricing surcharges is going to hit all at once. And we saw that in April. Headline inflation dropped to 1.7, which is really, really low. But then the tariff impact is only going to build very gradually throughout the year. So we're going to see potentially headline inflation just coming back more higher because of that. But at the end of the year, we're really not expecting inflation to go anywhere near what we've seen during sort of the post-pandemic period where it surged to really, really high levels. That's not something that we're expecting right now. And from a Bank of Canada standpoint, I think that this is one thing that I found to be quite confusing because when it comes to the two sides of things from tariffs, right? It obviously is growth prohibitive, as in it hurts the economy. We know it hurts the economy. And then it drives inflation higher. So from a central bank's perspective, it's been argued that they are essentially in this really tough spot where they're expected to support the economy by cutting rates, but at the same time, they also have to keep inflation in check. So they are, I would say that's largely correct. They do worry about inflation, but not so much the direct tariff-related inflation. When you think about it, they know prices will increase, and businesses have made that very clear that they will be passing on cost increases to consumers if they see it. They're worried about prices continuing to increase beyond what's warranted or justified by tariffs. So they're worried about just broadly sort of knocking the balance off of domestic demand and supply such that prices continue to increase and increase at faster and faster rates, even once, whatever the cost increases tied to tariffs are already fully accounted for. So that's what they call ongoing inflation, and that's what they're worried about. So at this stage, we don't really know if that's going to be the case going forward. But what we're seeing right now is also something concerning, going back to my earlier point, which is it's not so much tariff driving domestic inflation. It's actually a bit of something, domestic demand, which is a concerning backdrop.
And let's get to that, the sort of spending, household, retail side of this. You mentioned there's like a front running, pulling forward, whatever you want the term is. Like it's difficult to disentangle because car sales are up because I better get a car now before the tariffs kick in and I have to pay more. Or as we just went through 3 years ago, there are no cars, or the used market becomes just as expensive as the new market. I think there's a lot of risk of that in a lot of areas where the used market becomes attractive due to the absence of tariffs, and then all it does is drive the prices up to the new market levels. So despite everything, it does seem like the household spending is holding up. People are able to maintain their lifestyles in terms of just day-to-day spending, food, gas, all that. Is that accurate? Like, would you say we haven't seen the big downswing on the household spending side yet?
Yeah, I would say that's definitely true. So I think when we saw sort of the consumer confidence print for March, it was quite scary in a sense that it dropped to the lowest level in history and even below where it was during the pandemic, where the worst of the pandemic when 80% of the economy shut down overnight. So we were expecting quite a big hit essentially to household spending, and that's something that we did not see. So in comparison, the actual changes or course of progression for the household sort of spending over the course of February and March were much more mild and moderate in comparison. So we saw, 0.2, 0.3% decline actually in spending, and that's according to our own tracking of RBC debit and credit card spending data. So moderate contractions during those months, which are in line with the retail sales statistics from Statistic Canada. And then from March, actually, StatCan reported a 0.7% rebound in retail spending. And in April, what we're tracking right now, which is more timelier than sort of the StatCan official reporting, is that strength is continuing. We're seeing another big increase in spending in April. So maybe there's some element of initially, the hit to sentiment being overdone, and now it is maybe correcting. And that also has to do with Canada just broadly went from in April being one of the only few countries were targeted by US tariffs to now being the lowest, actually, of all countries that are seeing
It's all
US tariffs.
relative. Yes.
It's all relative. Yeah, exactly. So there's still tariffs, which means it's still like all else equal negative for the economy. But that kind of a relative ranking perhaps are shifting sentiment around as well for both businesses and consumers.
Yeah, it's interesting you mentioned COVID because the sentiment was more negative because with COVID, it was abundantly clear we were just going to empty the cupboard and every possible subsidy and support would be, there was going to be CERB and there was going to be mortgage deferrals and 0% interest rates and like whatever possible support for the economy was all going to be given. And that lifts things a bit. Whereas this, as you were saying, there's this ambiguity of, are we the only country in the world that has to deal with it? Like if we're pursuing a path and nobody else has to do that of easing, that's a challenge. Okay, so retail spending, it may have leveled off, it may drop, it may rise, but like where are the secondary effects of that? Like if retail spending is impacted or if inflation starts to drag on the economy, then we see that restaurants, discretionary spending, the labor market, like we'll see GDP drop, will we see an impact on the real estate market, the housing market? People are, there's still, pricing issues and there's a limit of what people can afford. So where do you see that, like if retail spending slows down, where is that? You mentioned secondary effects or knock-on effects. Like where do we see that the most? Is it hospitality? Is it discretionary? Is it real estate? Where does that happen?
Yeah, for sure. I mean, well, to date, I would just like to make it very clear that so there's a divide between what we call soft data and hard data. So soft data is your sentiment data, is your survey data. Hard data is your actual data, hard data. And we've not seen hard data nearly contract or deteriorate as much as soft data has been suggesting. So spending broadly has been holding up. And then in terms of forward outlook, we are kind of expecting something similar. We don't really expect the Canadian economy to go into a recession this year. That's just something that's not in our outlook. We expect very small and marginal growth from the economy, but we're not expecting something, even remotely close to sort of the global financial crisis or the pandemic. So that's our baseline outlook. And then what are sort of the risks to that outlook, right? Like he said, conditions or broader domestic demand could end up being a lot worse, or it could end up being a lot stronger, which looks to be the case right now, actually, to be frank. So on either side, I think those risks are largely balancing out. But to your point, if, like consumers or households are feeling like, the hit to labor market, they feel a bit more just cautious in terms of their spending decisions, which is typically what we would see. So very interestingly, savings rate, where how much households tend to save, usually rises at the onset of economic crisis,
Okay,
just
the
because they're
fear factor.
exactly
Yeah.
they're saving for contingency reasons. The wealth effect come into play as well. Stock market plunging a little bit, even though it's recovered partially as well. So all of that could play into this broad spending pattern or decision as well. They save a bit more because we're afraid that they're going to lose their jobs, and then potentially spend a bit less. But, we're not really expecting a lot of that to happen. What we're seeing again right now is to the contrary of that. It looks like spending is coming back a bit stronger than we're expecting heading into the summer.
Okay, I'm glad you say that because I sometimes I'm afraid these discussions skew a little negative, and the trade war is, it's an obstacle, obviously, but I wonder if we can close on the silver linings topic. Like there are some areas that will benefit from this, as crazy as that seems to say. Overall, yes, it's a negative and it will impact the labor market and GDP growth and everything. But can we talk about some areas that might do well or might benefit? I could say in real estate, we've identified a few areas. You mentioned hospitality, like hotels is an area. Suddenly, travel to Florida and Arizona has gone, I won't say to zero, but it certainly dropped more than it's ever dropped before. And travel within Canada is attractive. Resorts, hotels, national parks, these kind of areas. And then the nationalistic, if you have a made in Canada brand, perhaps this is your best year ever because people weren't paying attention to that a year ago. And now they are interested in made in Canada clothing, food, candles, beer, whatever it is. So, can we close that positive note? Like where are the areas of, say, opportunity or perhaps growth, even with this overall negative trend?
Yeah, for sure. Well, I think the biggest one, you kind of touched on it, is tourism. And we kind of talked about it in our podcast as well. Actually, a quick plug, RBC Economic, we have our own 10-minute day podcast where we talk about travel trends. And very interestingly, and it's almost exactly as you would expect, which is, the travel sort of from Canadians. And this is not only unique to Canadians either. It seems like even from Europe going to the U.S. and from Canada to the U.S. have all sort of declined quite a bit earlier this year just because of the tariffs. But then it seems like we're, at least from what I parsed through in the travel data, Canadians are still traveling internationally. They've just been swapping out U.S. destinations with other sort of international travel destination. But later on this year, heading into the summer, anecdotally, we've heard about tour operators in BC seeing a surge in demand this year from Canadians. I think it would definitely play out a little bit like that because in normal years, what we say, where will we call Canadians and that traveler abroad? And what that means essentially is that there are more Canadians doing foreign travel than there are foreigners coming to Canada for tourism. So all that foreign spending, most of them to the U.S. in a normal year would be saved for either domestic spending or, travel somewhere else. But nonetheless, it's more sort of purchasing power among households to spend on things discretionary for domestically. And the other one, and this is perhaps purely anecdotal, I think is transportation and warehousing is a difficult one because transport, a lot of it obviously is tied to cross-border trade. And we've seen some weakness over there in sort of the broader transport sector as well, alongside manufacturing. Those are the sectors that are getting hit or damaged. But then warehousing is one aspect because anecdotally, I've heard stories about a lot of sort of businesses, instead of importing directly into the U.S. and facing a lot of tariffs, they're parking a lot of what in their inventories currently in Canada. The Port of Vancouver as well, seeing some more traffic than usual. So there might be some of that playing out for businesses that are just waiting on the sidelines and to see how things would progress and say, okay, can we just, acquire some space and park our inventories before we get more clarity on whether we can export to the U.S.
It's interesting you say that. Industrial is... it's been such a hot market. And my initial impression, as you say, was this is a huge downside for industrial because the tariffed industries are huge, much bigger users of that space than they are office space, retail space, whatever. But as you say, the unintended consequences are starting to kick in, which is perhaps if we have a lower tariff rate than countries in Asia, you need more space here. Like these are... in the initial analysis, you don't think at that level. But again, you start to hear the anecdotes and hear the stories of perhaps it's better to just take some space in Canada for the short term and see what develops. Perhaps it will go away in 3 months or 6 months and it was a worthwhile investment. Anyway, so much to discuss. Thank you, Claire, for joining us. Hopefully there will be a third episode next year and we'll be discussing a somewhat calmer macro environment. Thank you to our audience for joining and watching. This is the Colliers Talks podcast. Thanks for joining us.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.